Hello and welcome. You're watching Rebooting India on NDTV 24/7. I'm Shweta Rajpal Kohli. First up, let's take a look at how the stock markets did today. Well, the Sensex and Nifty snapping their three-day winning streak, largely due to profit taking that took place and clearly concerns over the Federal Reserve's tapering of stimulus once again continuing to haunt markets, clearly ignoring the better than expected drop that we had seen in the current account deficit. The Sensex finally ending today's session almost flat but 43 points in the red. Nifty also ending the session in the red today, retracting from nearly a month high that we had seen it hitting on Monday earlier this week. Let's take a look at how the rupee did today. Rupee also trading, closing almost flat there at 62.36 against the dollar. But the big news, of course, remains a big sigh of relief for India's policymakers as the current account deficit has gone down sharply during the July to September quarter. In fact, this was a data that the central bank released almost a month ahead of the schedule, plunging to $5.2 billion versus $21 billion last year. And this is mainly due to rise in exports and fall in gold imports that has led to this record fall. So can we now say that India's economy worries are over? Let's now go across to Dr. Arvind Virmani to get a sense of what this data really means for India and for policymakers. Dr. Virmani, current account deficit shrinking at a record pace, down from $21 billion during the same quarter last year to now $5.2 billion. Has this been much better than expected, and can we say at least on this front worries are over?
Well, you might recall that we had discussed some months earlier that the exchange rate adjustment, which became necessary because of the interest differential, would help in this direction. So that part of it is not surprising for those of us who had said that the exchange rate would have a positive effect on exports. But the kind of new thing is the, well, not exactly new, but the recovery in the US economy. Again, in one sense it's new, but in another it's not, because the whole talk of tapering actually started because there was expectations of a US recovery. So by definition that would also mean imports would be drawn in. But I think perhaps because of all that trouble, domestic confusion which was there in the US economy, maybe there was a little bit of a bump up in imports which would not be there forever, so to say. But still, overall, the good news is quite clear.
So can we say that India right now looks much better prepared for tapering, because that is something that has to happen? It's a question of when and how much. So are we now looking like we're much better prepared for the stimulus tapering? That is something that will happen, or you think we still need to buckle up on that front?
See, the question is that this is just the start. So I don't think the adjustment or the preparation is over, because the issue was really how fast capital flows would change, and for that you need a lot of reserves. So it's not just a matter of the current account deficit. So one factor is going down. That means it will not be triggered by worries over current account deficit. If you remember, we were comparing different countries and why in India the fall was more rapid. That more rapid part is gone, but you will still have the general effects which will be there for all countries which received capital flows, and you still got more to do to prepare for that.
I'd like you to specifically highlight what has changed between August, when we saw the rupee actually fall to a record low of around 68, to now. We were talking about a real gloom and doom scenario. Do you think at least that scenario is not something that we should be worried about anymore? And talking specifically about the rupee, that's something that we can at least be assured that the rupee is stable, there are less worries about the currency now.
Yeah, clearly the gloom and doom part is over. So the question really is now about how quickly it will adjust and whether there will be a differential impact. As I said, the impact will be there, but at least it won't be driven by fears of a collapse. So that's where the doom and gloom comes in. That is clearly gone. So I think one can be reasonably confident. for another reason, which we haven't discussed so far, but is obvious, is the fact that it seems like the economy has bottomed out, has reached the bottom in the previous quarter. That was slightly unexpected. I must admit that I did not expect it. So the second quarter growth of increase of 0.4 from 4.5 to 4.8 is certainly adds to that
optimism,
removal of at least the gloom and doom. I mean, I wouldn't go and so far as to say we are now optimistic, but at least there won't be this sudden shock and this kind of expectation of gloom, so to say.
So the recovery that we've seen between the first quarter and the second quarter, first quarter being 4.4% growth that we saw, and second quarter at 4.8, has that made you more bullish on the overall year number also? What are you pegging India's growth at for this fiscal? Because that's been the big
it
debate.
Hasn't made me more optimistic. For if you recall, it was in that period when the taper, when everybody adjusted their growth forecast down by about 1%, and so mine went from 6% to 5%. The reason why I'm still not so optimistic is because the new monetary policy approach and the fiscal excess, if one can call it, in summary we can discuss, but means that monetary policy is likely to be tight, which means the growth could actually still be lower than 5%. I would say that there's more likelihood of it being less than 5% than more than it.